Thank you, David. Just before we start, the Food for Thought series are a series of trainings that DLA Piper offers to clients and other participants to the Luxembourg financial market on any hot topics relevant for the business market in Luxembourg. This series of seminars are generally hosted in our premises, but due to the current COVID restrictions, we are unable to do so. Host you here, offer you a small bite and chat with you after the seminar takes place. However, we will be taking questions. There will be a Q&A session after the presentation. You can, however, use the link to ask any questions you might have during the session, and we will take them either online after the presentation or offline if we don't have enough time to cover them. As a presentation of our office, DLA Piper Luxembourg is a Luxembourg office covering all relevant practices to business law. We are about 50 lawyers in Luxembourg and 7 partners, and we belong to an international network present in more than 40 countries. Getting now to the host of today, we have Lindsay Tulloch. Lindsay, do you want to say a couple of words about yourself?
Yes, good morning. Good morning, everybody. Yes, I am of counsel, a corporate lawyer in the funds group, specialized on alternative investment funds for quite a long time, 20 years or more, and work together with Lewis on the tax side. Thank you, Lewis. Over to you.
Thank you, Lindsay. So myself, I'm Luis Munoz. I'm a tax partner in Luxembourg. I have been handling international tax matters for almost 10 years. My main client base is composed of asset managers, investment banks, and multinationals, and I generally assist them on handling any tax matters related to their structure setup and on a deal-by-deal basis. But now let's get to the topic of today. David? So the topic of today is carried interest, and the first thing that we should ask ourselves is, what is carried interest? Carried interest is nothing else than a portion of the profits of the fund which is allocated to the management team for purposes of incentivizing their performance. What do we speak about when we're talking about incentivizing their performance? Managers are generally remunerated on a salaried basis. Their salary is embedded into the management fee, which is paid by the fund. And if they didn't have any exposure to carried interest, well, the remuneration would be the same no matter what they do, either whether they perform well or whether they not. So investors have, let's say, a motive of why they should provide their management with this incentive so that they generate value, they carry out investments that perform better and generate a better return for their capital that has been committed. Carried interest is also named promote in certain jurisdictions, notably in the US. It can also be referred to as preferred return. We see that more often in French-speaking jurisdictions. The reason why it's called preferred return makes reference to the disproportionate nature of the carried interest. And when I'm speaking about disproportionate, what it means is that the carried interest for a carried interest holder to be entitled, they will need to commit a certain amount. And the amount they commit, the return that it has is not pro rata, like it would be if they had done some kind of co-investment or acted as a regular LP, but rather there will be an overperformance of the amount invested. There is actually no link as such between amount invested and the return. As we mentioned, the return is driven by their performance and not by the amount that they're actually investing or committing into the fund. But speaking about that, David, can you go to the next slide? Thank you. So we're talking about how these beneficiaries can become entitled to these carried interest profits, right? And the way they do that is by becoming limited partners into the fund and investing this nominal amount that I mentioned when going through the slide before. And they can become a limited partner either directly by subscribing the units into the fund directly at individual level, or they can do so via a vehicle indirectly. And if they do that indirectly or via this vehicle, what normally happens is that you will see all carry holders, or at least the management team, pooling their investment into this vehicle, and then it will be this vehicle, the one becoming an LP in the fund, whereas the management team will be LPs of this carried interest vehicle. The purpose of this vehicle is double. First of all, it allows to have just one subscription at the level of the fund for the carried interest. And secondly, it keeps all of the arrangements that the management team may have amongst themselves with regards to the carry separate and private from the eyes of other parties involved in the setup of the fund, notably from the investors. But okay, now we know what carried interest is, how do the beneficiaries become entitled to it, but how does it work in practice? Lindsay, do you want to run us through?
Yes, can we have the next slide, please, Dave? Thank you. So we need to go one level further down. We need to look at the fund LPA, the limited partnership agreement of the fund itself, the provision that deals with distributing cash to the limited partners of the fund, what we call the waterfall. The principle is ultimately management is supposed to get a certain percentage of all profits of the fund, usually 20%, but there are a lot of varieties. It can be a higher, can be a lower percentage. Sometimes we have more than one percentage, depending on the performance of the fund, starting off with a lower percentage, 10%, say, or 12 or whatever. And if the fund reaches a certain multiple, we move up to the next percentage of carry. It can be 2, 3, 4 levels of carried interest. But before the managers start to get their carried interest, we first have to give the investors a reasonable return on their investment. Next slide, please, David. Thank you. So here we have the order. Distributions go first of all to the investors themselves until they've received a return of the capital they've contributed. The second stage is what we normally call the preferred return. As Lewis said earlier, in some jurisdictions, the carry itself is called preferred return, but usually in the industry, preferred return refers to this second stage in the waterfall. Once investors have received a return of their capital, second stage, they receive kind of de facto interest at what we call a hurdle rate, might be 8%, could be a different interest rate, so as to receive a reasonable rate of return on their investment. And only after that has happened do distributions go to the management. First of all, the so-called catch-up. If the carried interest percentage is 20%, then the management will get in the catch-up the amount sufficient to give them 20% of all profit, so that would be 25% of the preferred return to the investors. And once the catch-up has been paid out, then it simply goes 80-20, the normal 80-20 split between investors and the management team. Again, there are variations on the above. In the third stage, the catch-up phase, is not necessarily the case that all of the distributions will go to the management team. You might see, I don't know, 80% going to the management and 20% still going to investors. That obviously prolongs this third stage, the catch-up phase, because some of the distributions are going to the investors. But in the end, at the end of this phase, the management team, the carried interest, will have received the requisite percentage of those profits. Next slide, please. For that first stage, we have two fundamental methods, what we call the European waterfall or fund as a whole waterfall on the one hand, and the US waterfall, the deal-by-deal waterfall on the other hand. The European waterfall, fund as a whole, means in the first stage, the fund returns to the investors everything they've invested in the fund, both in the investment that has just been exited and in all the other investments, and indeed any other purpose for which commitments have been drawn down to pay costs or management fee. Sometimes you see an even more extreme first stage, what we call a super hurdle. So in the first stage of distributions, investors receive distributions not only equal to the contributions that they've made, but also equal to as yet undrawn commitments. So that once they've received that, there is no more capital at risk, not even potentially at risk, even when later drawdowns occur into the fund. The US waterfall, the other extreme. First of all, you return to the investors only that amount that has been drawn down into the investment itself that has been exited, and also investments that have been fully written off. But all the other investors, or the other investments that are in the portfolio of the fund that are still valuable, that are still ongoing, the capital contributed to them is still locked up in those investments. So that means that distributions to the carried interest occur at an earlier time than in the European waterfall. Back to you, Lewis. Should we go to the next slide, please, David?
Thanks a lot, Lindsay. So as Lindsay just showed and demonstrated, there are different systems, right? So you have the safest system of them all, which would be the super hurdle under the European standard carried interest distribution waterfall. Then you would have the normal waterfall, which we generally see in the Luxembourg market. And in the most extreme scenario, on the other side, you would see the US waterfall, which is computed on a deal-by-deal basis. And why do we say that one of them might be the most conservative and the other one the most aggressive? The reason is that the US version of it is less investor protected. And why do we say that? You need to think about that the waterfall or the allocation or the final determination of who gets what is done on the basis of the performance of the entire life cycle of the fund, not on a deal basis. So once you come to the end of the fund, you compute what was the profit, the return, the commitments that have been returned, and then you can compute correctly how much carry should have been paid. If you, however, applied, let's say, the US taxes, the US waterfall system, and then you start distributing on the basis of the performance of a given investment, and you have a very good performance on your first 2-3 investments, you will be paying carry out, right? But what if your latter investments perform badly? And maybe there is even more capital invested in those investments than in the ones that performed really well. In that case, you can end up in a situation where even the investors, by the end of the life cycle, are not even able to receive back the capital they committed, but the management have already received carry. So that obviously is not the best situation to be. So in order to mitigate the impact of that situation, investors will request that there is a clawback provision embedded into the fund documentation, normally into the LPA. And this clawback provision will foresee that the fund will be able, after the final allocation is computed, to claw back from the management team any amounts distributed under the carried interest in excess of what they should have obtained. There's, however, a limit to that to protect also management. That limit is any amounts used to pay taxes, but the amounts in excess of these taxes will revert back to the fund and go to the investors so that they can ensure that the amounts they should have gotten are in the end paid out to them, minus the taxes of the management, of course. So that's why I say if you go for a US waterfall, investors might be less protected than under a European waterfall. Sometimes, let's say, a solution that is also sought is to have some kind of escrow account. When I say escrow, it's not really a third-party bank providing an escrow account. It's rather the fund will set up the amounts or a certain amounts or proportion of the carried interest aside in a bank account and will not distribute it to the managers until they're more or less certain that those amounts will be available for distribution under the carried interest. Let's go to the next slide, please. So taxation, that's my favorite topic. Taxation of carried interest. We could spend the whole day discussing about structuring alternatives, but we will just go through the principles, okay? So when we're talking about structuring of carried interest for tax purposes, the main objective is to obtain the best tax treatment possible for the management team when they receive the amounts. So indirectly, what you're saying is that you need to check with the local tax advisors of the jurisdictions where your managers are located and work together with your Luxembourg tax advisors to achieve this result. Normally, what we see is that certain jurisdictions like France or the US, well, in the US, let's wait and see, because following the latest plan by Biden, it seems like their carried interest regime might be removed. But okay, currently France and the US, they have specific carried interest tax regimes that provide for a fixed tax rate when the payments qualify under their definition of carried interest. So the aim in those situations would be to have that income qualify under that regime, right? In other cases, you don't have such a regime, or carried interest, when it's paid, it just taxed at the standard progressive rate, like it's a case of Luxembourg. So in those cases, what you try to achieve is to obtain a more favorable tax treatment using your tools available. And the tools that you have available are normally converting that type of revenue into passive income, normally capital gains. Capital gains in Luxembourg, subject to certain conditions, are generally exempt from taxes. So you would try to have your managers redeem this as security. So the carried interest would take form of a security subscribed by management, and this security could be redeemed, thus creating a capital gain at the level of the manager. This is also used in other jurisdictions like the UK or Germany in some cases, but that's what you would be trying to achieve. There are certain considerations to be taken into account, like abuse of law, etc. So in order to mitigate this kind of issues, what you normally see is that managers will be requested to subscribe the securities at fair market value. The sooner they do that in the life of the fund, the lower the fair market value will be. So these are kinds of things that we very much generally see. From a Luxembourg tax perspective, I think two main hurdles have been created by the legislation during the last couple of years. First of all, I'd say is ATAD 2, in particular the application of the reverse hybrid rule, which comes into force as of 1st January next year. And that does not directly impact the tax treatment of the carried, but it does impact the way you structure around it. Or because when you're structuring carried interest, you will generally make use of the pooling vehicle that we mentioned before. You will make use of this carried interest vehicle. And that vehicle generally takes the form of a tax transparent vehicle, namely a partnership in Luxembourg. And in some cases, if your managers are located in jurisdictions that consider that partnership as opaque in their jurisdictions, that will trigger these anti-hybrid rules I was speaking about. And as of next year, your partnership, your carried interest vehicle may be subject to taxation in Luxembourg, which would be, to say the least, not efficient. The other obstacle is DAC 6. So DAC 6 will not have a direct impact on the tax cost or on the return of your management of the carried interest going to the managers, but it is true there is a certain reluctance to report this kind of structuring exercises. And the thing is that it is a very much a gray zone, because what you are trying to achieve is to, well, you have a revenue stream and you want it to qualify for a certain beneficial tax treatment for your management team. And there is a hallmark under DAC 6, hallmark B2 on conversion of income into any other type of revenue, capital, etc., that may benefit from a more beneficial tax treatment. And therefore, when carrying out this kind of structuring exercises, it's always good to have the view of an experienced tax advisor on whether or not reporting should be done. Once again, that should not have any kind of economic impact on the end result. Let's go to the next slide. Okay, so when we speak about beneficiaries of carried interest, you would normally imagine it being the management team. And for the most part, you would be correct. However, there are all sorts of different parties involved in the life of the fund who might get exposure to the carry. It will also be the case of, for example, external consultants that may aid the management team take decisions with regards to the investments made by the fund. But you can also see people that have nothing to do with the investments being carried out or anything regarding the management of the fund itself. You could see a placement agent being remunerated either partially or entirely via carry. And what we also see very often is when you have, for example, a cornerstone or key investor that is there and the entire launch of the fund might be dependent on his commitment, well, they're in a situation of power with regards to management, and they may ask that the return of their investment is not impacted by the waterfall, in the sense that they do not want to see the managers receiving the carried interest. They want to receive that portion as part of their return. And what they will normally do is that they will receive a carry entitlement for those amounts, so that de facto what is occurring is that they're being reimbursed any amounts of their return qualifying as carried interest. Okay, let's go to the next slide. What happens then if we have all of these galaxy of different potential beneficiaries. When do they become entitled to the carry? Well, it depends on the role they play, because if we are talking about a key investor who's there for the launch of the fund, then that particular beneficiary will become entitled as of the inception of the fund. If you have a founding member of the management team, the same applies. But what happens if you have, for example, a new joiner in the management team? Well, in that case, he or she might only be entitled to this carried interest once he joins the team. There will also be variations as to what's the amount of carry that you are eligible to receive. And that might depend on your performance. For example, if you have a manager which is performing very well, the amount of profits allocated to him will be increased. The same applies if he is promoted. The contrary might apply if he performs poorly, although, to be honest, we see that very rarely because asset managers are very reluctant to accept these kinds of requests from investors. And in cases, for example, that someone decides to leave the management team, well, there is no reason why investors would like to further incentivize this person who has nothing to do with the investments into which they have invested. So what occurs is that when somebody leaves, their points are reallocated amongst the existing beneficiaries. But all of this seems pretty complex. So, Lindsay, is there anybody in charge of managing all of this?
Yes, David, next slide, please. Yeah. Next slide, please, David. Thank you. Yes, indeed. Somebody has to make these decisions. What Lewis has explained is who is fundamentally eligible to participate in the carry, but somebody has to decide who is going to be invited to participate and how many carry points, what proportion of the carried interest will go to each of these individuals, and any variations, as you say. If somebody performs well, is their carry entitlement going to be increased? If somebody performs badly, where a fund does have this ability, or the management team does have this possibility to decrease somebody's carry entitlement up to a certain limit, who decides on that? It will usually almost certainly be a committee, normally referred to as the Adjudication Committee. It's similar to the Remuneration Committee under the IFMD, or generally in financial institutions and other large firms. It wouldn't necessarily be the same committee. It might well be the same individuals, but perhaps it's separate from the management of the fund. It's separate from the board of the general partner of the fund. It may even exceptionally be just one person, particularly where we have a new setup, for instance, a spin out from an existing experienced management company, financial institution, where there's just one senior person who gathers a few junior people around him or herself. Initially, in the initial phase, it may be just this one person who makes all the decisions. But as the team matures and becomes more mainstream, that function will be adopted by a committee, usually an odd number of people, 3 people, 5 people, who will make these decisions, whether it be by majority vote or unanimously. Can we have the next slide, please? So one major area where carry entitlement will vary is when people leave the management team. They may lose some, they may lose all of their carry points, but they will keep the distributions already made. You don't have to give anything back, apart from the clawback that we've already discussed, and we're going to discuss again in a minute at the level of the carry vehicle. If somebody leaves the management team, if they're a bad leaver, you would normally expect them to lose all of their carry points. So future distributions of carry will pass them by. They won't get any more carry distributions. Who's a bad leaver? This is somebody who's guilty of particularly egregiously bad behavior, the sort of thing that will get you sacked without notice, summary dismissal from your employment contract. Somebody who commits fraud or embezzlement or racial harassment or something awful, or possibly a serious breach of the partnership agreement of the vehicle, breach of confidentiality causing significant damage to the fund or to the investors or to the portfolio company, anything like that, then that may cause somebody to be designated a bad leaver and lose their carry entitlement altogether. If you're not a bad leaver, you just leave to take up another job, or you retire, or if you die, there will normally be a vesting schedule which will dictate how much of your carry you lose. Can we move on to the next slide, David? Because we have an example of how a vesting schedule might look. This is a linear vesting schedule over 5 years, so that if you join, say, 2 years into the fund, that would be 0.0 in the left-hand column. You join the management team 2 years in, that's 0 for you. If you then leave 3 years later, that'd be 5 years, year 5 in the lifetime of the fund, but 3 years of your belonging to the management team. Then it says here in the middle column, you lose 40% of your carry, which means that 60% you retain. 60% is vested. What happens to the points that you lose? Your unvested carry, that is then reallocated among the remaining members of the team. It could be allocated directly, immediately to everybody, or it might be kept in reserve until somebody joins the team later on to replace you. But there are many variations on this. It doesn't have to be a linear vesting schedule. It can be front-loaded, for instance, that a high amount is vested right from the start, or alternatively, it can be delayed so that for the first 2 years, nothing vests, and then it picks up gradually over time, for instance. It doesn't have to be 5 years. We often see longer periods, 7 years, 10 years. It may be linked to the investment period, so that, for instance, 70% of your entitlement vests at the end of the investment period, no matter how long that has lasted, and the remaining 30% vest in a linear fashion thereafter during the remainder of the lifetime of the fund. It may not be linear based on time. It may be based on drawdowns into the fund. So the more you draw down and invest, the more of your carried interest is vested. There are many, many varieties, many variations which need to be discussed when setting this vehicle up. David, next slide, please. Oh, yes. What I should also point out is that we wouldn't necessarily we might sometimes see a class of levers which are not subject to the vesting schedule, which are the super good levers. People who die in harness, people who are incapacitated, it's not their fault, they can't work any longer. People who reach the statutory retirement age, so they don't leave to join somebody else, they leave and don't work at all anymore. Some funds, some management companies have a system that they keep all of their carry points. Others take the view, well, it may not be their fault that they died or they're incapacitated, but they're still not contributing to the management of the fund, so therefore there's no need for them to be incentivized. They ought to be subject to the vesting schedule. We sometimes see further classes of levers, to just not the normal levers who just leave, but intermediate levers who might go and join a competitor, for instance, somebody who competes directly with their former employer. We might want to punish those people by making them subject to a more severe vesting schedule, so they lose more, so that they only keep half of what they would have kept if they'd not joined a competitor, or if they trigger the keyman clause in the level of the fund, that should be disincentivized as well. We often see that in many funds. Next slide, please, David. Back to you, Lewis.
Thank you, Lindsay. Before I continue with the presentation, just a quick reminder, if you have any questions with regards to the presentation itself or to the topic, carried interest, don't hesitate to use the Q&A button below on your screens, on your Zoom screens. Okay, so clawback. We spoke about clawback at the beginning of the presentation, right? We mentioned investors will request from the management that in the LPA or in the fund documentation, there is a provision allowing the investors or the fund itself to claw back any amounts distributed in excess of what the manager should have received with regards to the carried interest. But there is a small legal barrier to that if we take into account that, well, managers generally or most often will invest via a pooling vehicle, and they will not themselves be LPs in the fund. They will have no contact, no legal contract with the fund or contact with the LPA whatsoever. So what occurs is that if there is a carry vehicle, the carry vehicle itself, its documentation, will need to foresee the same clawback provision that the fund has, under the same triggering events, same conditions, everything the same. And the purpose of this is that if this provision at the level of the fund is triggered, it will also be triggered at the level of the pooling vehicle. And the pooling vehicle will be able to claw back the amounts from the management team, and the fund will be able to claw back the amount from the carry vehicle and provide it to the investors as foreseen in the waterfall of the LPA. It seems a bit complex, and that's why there are shortcuts. What shortcuts are there available? So what we normally see is that either the GP of the carry vehicle, if it takes the form of a partnership, will provide the investors with the right to exercise this clawback provision directly, or you might even see the management team providing a guarantee to the GP of the pooling vehicle, and this guarantee will be provided to the investors so that they can exercise it directly. If the clawback provision is exercised, it is important to mention that each manager or each beneficiary is responsible to provide back their own amounts received. There is no joint liability. So if manager A does not provide back to the carry vehicle the amounts it received, manager B will not be responsible for providing those that management A did not provide back. Okay, next slide. Transfer. So potential transfers of carried vehicle. That brings us back to the topic of what is the purpose of the carried interest. Carried interest is there to incentivize the performance of the managers. So if it's going to be a cost for the investors because it's going to reduce their return on the investment that they've made, they might as well get a bit of something in return. And what they're getting in return is an increased performance of the managers. So they will want to ensure that what they're paid, that they're getting their money's worth for what they're paying. So that's why investors will request that in the LPA there are certain restrictions to a potential transfer of the carried interest rights. What do we normally see? What we normally see is that the LPA will foresee that the managers or the beneficiaries cannot transfer their rights to third parties and cash out. Reason, once again, what's there into this for the investors if the one receiving the carried interest has nothing to do with the performance of their investment? And the second point, or the second option that we see generally in LPAs, and it's linked with the first point, they will establish a certain minimum threshold or minimum percentage of the carry points that need to be allocated to the management team and cannot be allocated to other investors or other parties involved in the life of the fund. Let's go to the next slide. And this one is an interesting one because we've been very keen on mentioning how important it is to incentivize the performance of the managers. But then you might think, okay, so the managers are driven solely and exclusively by the performance of the investments. So if I were a manager, I would take on all risks possible to increase this carried interest entitlement as much as possible. But if you were an investor, you wouldn't want that, right? Because you've committed your capital, you put your money into the investment, and you are putting it at risk, and you want to see those amounts back with the returns. So in order to smoothen out a bit the risk profile of both management and the investors will request that the managers put a bit of skin in the game, that they actually also act as LPs, as normal investors. And what they will do, or what they will have to do, is that they will, normally it's around 1 or 2% of total commitments. Management will need to pay up those amounts, and for those amounts invested, they will receive exactly the same return that any other LP would, pro rata to what they have invested, of course. So once again, big difference between what is carried interest and what is a co-investment. So this co-investment smoothens out the risk profile curve, as I was mentioning, and it aligns the interests of both management and the investors. What form can it take? Well, once again, what we generally see is that either the managers will use the pooling vehicle to pool as well the co-invest and the carried interest, or that they will become LPs directly into the fund. Although most often than not, we see them using the pooling vehicle because it assists them from an administrative perspective, but also from a tax perspective. In some cases, you might see that they will try to achieve this best case scenario for the tax treatment of their return on both their co-invest and their carry. Once again, you need to check with your advisors, be careful about DAC6. These are things to be taken into account. Okay, but Lindsay, how does it work if we want to use a pooling vehicle to invest into the fund?
Yeah, thanks. Yes, so we go to the next slide then, please, David. Sorry. Thank you. Yeah, this obviously has consequences for the LPA of the carry vehicle. It makes it potentially more complicated. And Lewis, you said your favorite topic is tax, and my favorite topic is drafting agreements for complex things. Sorry, I'm a nerd. Yes, so the of the parties to the carry LPA, all of whom are going to be entitled to the carry, some or all of them will make commitments to the carry vehicle just as if they were investors in the fund. And those commitments will be drawn down into the carry vehicle in the same way as commitments are drawn down into the fund from the normal investors. And then when the money comes into the carry vehicle, that will then be drawn down into and paid into the fund by the carry vehicle because it is an investor in the fund. And it means potentially we have two different profit allocations in the carry vehicle. We have one profit allocation for distributions received that represent carried interest. That is distributed among the limited partners in proportion to their carry points, which could be increased or potentially decreased, as we discussed, maybe subject to vesting when people leave. And we have a separate profit allocation for those limited partners who have made commitments and distributions which are received by the carry vehicle that represent a return on the investment in the fund, like a normal investor. That will be distributed by the carry vehicle to its limited partners in proportion to their commitments. We can make those things the same formula. You mentioned earlier, Lewis, that for tax purposes in particular, it's often desired to make the carried interest effectively an enhanced return on somebody's investment. It would have the same formula, the same proportions of distribution for the carry and for the investor return. That opens up a whole raft of new questions and what happens to the commitment when somebody leaves. But that's perhaps going a bit too far. But yes, it makes the vehicle in its limited partnership potentially slightly more complicated, but it's all doable. David, next slide, please. So it may be the case that where members of the management team make a commitment to the vehicle and ultimately to the fund, that they don't actually have enough money themselves to fund that commitment. They may need to incur debt in order to satisfy drawdowns to them. We see that quite frequently. So there will be a loan facility between often one bank and either the individual carry holder or the vehicle in total. So the bank will provide loans to the vehicle or to these individuals each time a drawdown notice comes from the fund to the carry vehicle. The bank will require security for that loan facility, and the obvious asset to be used as security will be the investment of the carry vehicle into the fund. So the proceeds coming out of the fund, out of that commitment, out of that contribution, will be assigned to the bank as security, as collateral for the loan. In the event of default, the bank can exercise that security. Usually the bank won't want to become a limited partner in the fund itself. So what would normally happen is that if that happens, that slice of the carry vehicle's investment in the fund will be sold to a third party at hopefully fair market value with a discount. And the proceeds of that sale will be paid to the bank to satisfy its claim against the defaulting carry holder, member of the management team. Short of exercising the security, the bank may exert or may declare a stop funding event if the manager fails to satisfy its obligations to pay interest and installments on the repayment of the loan. That may be a stop funding event, which means that the bank will no longer satisfy future drawdowns. That will of course make the situation worse because the manager will now be in default not only to the bank but also to the carry vehicle, and the carry vehicle potentially in default towards the fund. That will likely accelerate the whole exercise of the security by the bank. Shall we move to the next slide, please, David? Yeah, finally, what we've discussed up to now is that we would have, for one fund, one carry vehicle. We may well have, in one management company, multiple funds being operated. We can have, on the one hand, we can have vintages of the same kind of fund. Fund 1 is fully invested, we raise fund 2, that's fully invested too. We raise fund 3, we're investing fund 3, but funds 1 and 2 still exist with a certain amount of their portfolios for which we are still looking for potential purchasers. So we have multiple vintages of the same kind of fund going on at the same time. We may have funds at the same time with different strategies. We will have, say, a growth capital fund focusing on Western Europe. We may have a venture fund focusing on just one country there. We may have a debt fund. We may have different parts of the management team focusing on different funds. And so their carry entitlement may vary depending on which fund we're talking about. The easiest solution is to have just one carry vehicle for each fund. But clients will often say, actually, no, that's too complicated, too expensive. We just want to have one carry vehicle, which will receive the carried interest from all of these funds. That means that we have to deal with potentially different entitlement proportions for each of these funds. We have to deal with that all in the same vehicle. We can do that. So what we typically do, we have one schedule for each fund showing how the carry is allocated among the limited partners for that particular fund, how the commitments are allocated among the limited partners for that particular fund, and we may even have different vesting schedules for the different funds, for the different parts of the management team. So, as I said, all doable.
As you're saying, Lindsay, for multiple funds, and we see this request coming sometimes from asset managers, because obviously it's easier to just have one vehicle, right? But this comes with a lot of different complications. Some of them you have already mentioned them, but for me, who I'm handling generally the tax matters, it also becomes a bit of a nightmare to try to achieve the best tax treatment possible for all of these different managers resident in many more jurisdictions than I would have had if I had had one vehicle per jurisdiction. Also, it makes it complex from can we use a limited partnership or not? Once again, reference to ATAT 2. These are all questions that need to be asked. And obviously, the smaller the amount of managers involved, the less the amount of jurisdictions, the easier that and cleaner that the structuring exercise becomes. If we have a lot of funds with people across around the globe and we try to achieve best tax treatment in all of their relevant jurisdictions, and at the same time that it's efficient from a Luxembourg tax perspective, it can become really cumbersome. Okay, let's go to the next one, which is our last slide, just to sum it all up. So as a reminder, the purpose of carry is to incentivize the participants. Generally, these participants will mainly be the management team. The point of it is to have them align their interests with the investors, both from the perspective of risk profile and also to be motivated to generate value for the investors while protecting the investment of the investors or the commitments that the investors have made towards the fund. When structuring, we always aim, it's obvious, to obtain the best tax treatment possible in the jurisdictions where the management is located while not incurring on Luxembourg tax slippage. If there are levers, there will be reductions on their profit points. And it is a very important one. The nature of carried interest is that although sometimes because of structuring exercises, co-invest, etc., you might see it being aligned with the capital commitment made by the managers, it has actually nothing to do with it. It's totally disproportionate to the amounts that the managers have invested. So that's been all on my side. Lindsay, do you have anything else to add?
Not really. That was a good summary. Shall we go straight to the
head to the Q&A session?
Yes, indeed. I see we have a few questions already.
We do have a few questions. Most of them not tax related. So, Lindsay.
Oh, lucky me. Mm-hmm.
Lucky you. First question, how does a clawback act on investors or on managers that have already left? What if we have a carried interest beneficiary who has left, and after that, after him leaving, we have a clawback event? What occurs generally?
Yeah, well, of course, that's potentially a difficulty. So there's a legal claim against that person. In signing up to the limited partnership agreement of the carry vehicle, this person will have agreed to fund his or her share of any clawback, and the LPA will say that this obligation persists after the person has left. So it's an obligation like confidentiality is usually continues to apply after the person has left the partnership. So that clawback obligation will continue to apply. As you explained earlier, we from time to time see that the investors can exercise their clawback rights directly against the carry holders themselves, either because the carry holder has given a guarantee or an undertaking directly to the investor, or because the GP on behalf of the carry vehicle has assigned to the investor the right to exercise the clawback claim against that person. And that will still continue to be the case after the person has left. Obviously, there's potentially a difficult gone God knows where. We don't know where that person is, but that's a risk that you're always going to have with people who are employees and they have their own lives, and who knows what they're going to do after they've left.
Absolutely.
Yeah, in the end, the only way to resolve that, I guess, is for the person to leave an amount in escrow to secure any potential claim against them.
So in the end, investors are protected, or they should be, at least. Okay, just a clarification, because I see the question in the Q&A section. The slides should be shared, right, David? I think this will be shared with the participants. Or Lucy?
Yeah, slides will be shared with everyone, and the recording too.
Perfect. Okay, let's get to another one. Lindsay, sometimes we see the management team not receiving a carried interest, but they receive other type of remuneration driven by the performance, some kind of performance fee. Why is that?
Yes, that's true. It's not necessarily what we've talked about is carried interest paid as a participation in the fund as a limited partner, directly or indirectly. Sometimes we see it paid as a fee, and that is often the case with funds whose activities are particularly active, which are regarded, I think, for tax purposes as trading activities, active business activities. Hedge funds are often like that. Debt funds maybe like that, because they'll receive interest income. And if that's the case, as I understand it, you tell me, you're the tax person, but as I understand it, it's very difficult to get any kind of beneficial tax treatment for that kind of income. And so you might as well not bother. And the fund will just simply pay a performance fee to some vehicle or directly to the individuals, and they just pay full tax on that as if they were receiving salary.
Yeah, that is exactly the point. So sometimes, because of the nature of the investments, it is just not possible to fall within the definition of carried interest. Like you have this in debt funds, you have this in, as you mentioned, Lindsay, hedge funds. So in those cases, as you know that the income, the carried interest is going to anyhow be taxed at the standard progressive rate, it's just easier from an administrative perspective just to have a performance fee paid out of the fund, and that's it. So indeed, tax does have a lot to do with the fact that sometimes we see a performance fee as opposed to carried interest being structured. There is another one here, which is a tax one. In some jurisdictions, taxes are levied when entitlement to income arises, even in the absence of a distribution. What happens? Well, in those cases, and this is something that we generally see in LPA. So when you see the fund documentation, you will see that there is a clause on tax distributions. And tax distributions act as an advance for the carried. So if you have a manager which is resident in a jurisdiction that will levy taxes once you have the right or the entitlement to receive a certain amount, the amount of tax that would be levied on that entitlement will be distributed by the fund as an advance on the carry. And when the carry distribution occurs, it will be distributed minus the amount that was already advanced. So that's the solution that is generally foreseen in the LPA to avoid this kind of dry income or taxation of profits which have not really been, let's say, there's no cash distribution that has occurred as of yet. Let me check another one. Lindsay, we have one of the assistants that would like you, if possible, to run through the catch-up feature just one more time, very quickly.
Sure, or maybe not quite so quickly as the first time around. Yeah, okay. I'm not on mute, am I now? Yeah, so the idea is, yeah, let's assume we have 20% carry. The management team is supposed to get 20% of all of the profits, but we have a priority of distribution. So initially, money will go to the investors. Let's assume we've done the first stage already. We've paid back all the contributions to the investors. We're now starting to distribute profits. Let's assume the first slice of profits that go to the investors will be 800,000. The reason why I'm choosing that figure, 800,000 goes to the investors. Up to that point, they've received 100% of the profits. The management team has received nothing. So the next amount that will go to the management team would be 20,000. Nothing goes to the investors. 20,000 goes to the carry vehicle. At the end of that phase, 100,000 have been distributed as. Sorry, did I say 80,000 or 100,000 to start with? I can't remember. 80,000 as preferred return, 20,000 as the catch-up. At the end of that phase, we've distributed 100,000 of profits. And if you look, 20,000 is 20% of 100,000, so they have received the right amount, right percentage of the profits. And after that has happened, this phase, this third stage of the waterfall has been completed, and we can go to the 80-20 split.
Thank you, Lindsay. Let's see again, what can we find? So there is a good one on tax, on ATA 2. What happens if you have a management team who is actually merely composed of managers located in a jurisdiction that would not allow you to use a pooling vehicle in Luxembourg because of the anti-hybrid rules? Well, then you're in a bit of a pickle. So first option is you take a strict reading of the law, and I mean, it's a bit like with the interest limitation rules. There's fingers crossed and hope for, let's say, kind of environment at the moment. Everyone's hoping for a bit of clarification on the application of these rules by the tax authorities. We'll see whether anything comes in this regard. But as it currently stands, one could even make an argument that the reverse hybrid rule should only apply if you have a Luxembourg vehicle below that could be deemed as an associated enterprise. But if not taking that approach, once again, needs to be supported by some kind of guidance by the tax authorities at some point, your only alternative is going to be to use a foreign vehicle who might not be subject to these reverse hybrid rules. Noting that the reverse hybrid rule will be applicable throughout Europe, you might need to use a foreign partnership for your investment. What else do we have? Lindsay, we have a comment here on carried vehicle, and you have a carry vehicle with a co-invest, but it doesn't work via a commitment. So the carry would not be drawing the monies itself. Someone else in the example is mentioned, the GP would cover the costs of the commitments of the carried vehicle. Is this something that can be done? And then there is
really the commitments or just the costs of the vehicle, the running costs of the vehicle?
For the, I think so. The comment is on the costs. But they mentioned that the carry vehicle would not be constructed with a proper commitment way, which is a bit odd in my opinion. If you have a co-invest, you should have a commitment. For the cost, you can advance the cost from another entity and then have a receivable, of course. But
yes, well, let's put the commitments, the actual investment to one side. If it's just a pure carry vehicle, which is only receiving carried interest, it's still going to have its own costs. There's going to be establishment costs, and there's going to be ongoing costs. whether or not it pays a separate management fee to the general partner, it's still going to have its own operating costs, running costs, domiciliation fee, administration fee, accounting, whatever, possibly even auditor. And somebody's going to have to pay for those costs. That really needs to be thought about when setting the thing up. The money's going to have to come from somewhere. The cleanest solution is for capital to be provided by the limited partners of that vehicle, so that they will subscribe for units or carried interest points, and each point will cost a certain amount of money, 50 euros or whatever. You have to determine how much money you're likely to need until distributions start to arrive from the underlying fund. If you don't do that, the carrier vehicle is not going to have the money to pay for its costs. Somebody's going to have to pay for it. And then, yes, it could be the GP, which will then need to be reimbursed later on out of distributions received by the vehicle. You might get a loan from elsewhere in the group. If there's a company elsewhere in the group which does have the money, it will make a loan to the vehicle, and then later when distributions arrive, that cash will in priority be used to repay that loan. That is also possible, obviously.
Understood. Thanks a lot, Lindsay. I don't see any more questions on the feed. If anybody has anything further, we're happy to reply to it.
Whereas we're pretty much close to the end of our allotted time anyway. So.
Then it was perfect timing. Nothing else on my side. Just thanking you all for the interest shown and for having assisted. And we will be more than happy to host you at our premises in the future once the restrictions are levied. Thanks a lot, everybody, and have a nice weekend.